Hey everyone, welcome back to the channel. I'm Chloe William, and if you care about your investments, your future, and your financial well-being, then you need to hear this. Today, we're talking about something critical: stock market volatility. The markets have been on a roller coaster lately, haven't they? One day you're up, the next you're down. It's enough to make anyone's head spin, especially if you're constantly checking your portfolio. And I know it's easy to get caught up in the headlines, the fear, the uncertainty. But that's exactly what we're not going to do today. Instead, we're going to break down exactly what market volatility is, why it's happening right now, and most importantly, what you can do to not just survive this, but to potentially even thrive. So buckle up and let's get started. So let's start with the basics. What exactly do we mean when we talk about market volatility? In the simplest terms, volatility refers to how much the price of an asset, like a stock, a bond, or even the entire market, fluctuates over a certain period of time. Think of it like a roller coaster ride. A volatile market is like a roller coaster with steep drops and sharp climbs. It's a wild, unpredictable ride. A less volatile market, on the other hand, is more like a gentle train ride through the countryside. There might be a few bumps along the way, but it's generally a much smoother experience. Now, these price swings, these ups and downs, they don't just happen in a vacuum. They're driven by a whole host of factors. Everything from economic data releases to geopolitical events, interest rate decisions by central banks, even unexpected news from major companies. For example, let's say there's a surprise announcement that a major economy is slowing down more than expected. That news could send shockwaves through the market, causing investors to sell off assets and leading to a sudden drop in prices. On the flip side, positive news, like a breakthrough in a new technology or better-than-expected corporate earnings, can spark a surge in buying activity, driving prices upward. It's a constant push and pull, a delicate dance between fear and greed, risk and reward. And understanding this fundamental concept of volatility, this ebb and flow of the market, is absolutely crucial for any investor, whether you're just starting out or you've been in the game for years. Because here's the thing, volatility is inevitable. It's a natural part of the market cycle. Trying to avoid volatility altogether is like trying to avoid the rain. It's going to happen, and the best thing you can do is be prepared for it. Alright, so we've established that volatility is a natural part of the market, like the changing seasons. But what's stirring things up right now? Why does it feel like we're on a particularly wild roller coaster ride these days? Well, there are a few key factors at play, all intertwined and influencing each other in a complex dance. Let's break them down. First and foremost, we have inflation. It's been the buzzword on everyone's lips for months now, and for good reason. Prices for everything from groceries to gas to housing have been steadily climbing, putting a strain on household budgets and creating uncertainty for businesses. And when inflation rears its head, central banks often respond by raising interest rates. Which brings us to our second factor, interest rates. The Federal Reserve has been aggressively raising interest rates in an attempt to tame inflation. Now, on the one hand, higher interest rates can be good for savers and lenders. But on the other hand, they can also make it more expensive for businesses to borrow money and invest, potentially slowing down economic growth. And then there's the ongoing war in Ukraine, which has added another layer of complexity and uncertainty to the global economic outlook. The conflict has disrupted supply chains, fueled energy price volatility, and raised concerns about geopolitical stability. And let's not forget about earnings season, that time of year when companies report their quarterly financial results. Strong earnings can boost investor confidence and send stock prices soaring, while disappointing results can trigger sell-offs and market dips. So, as you can see, there's a lot on investors' minds these days. It's a perfect storm of factors contributing to the current market volatility. But remember, it's not just about identifying these factors in isolation. It's about understanding how they interact with each other, how they create a ripple effect that influences market sentiment and drives price swings. I know. It's easy to get caught up in the headlines, the doom and gloom, the feeling that the sky is falling. But here's the thing. Panic is never a good investment strategy. In fact, it's often the worst thing you can do. Remember what we talked about earlier? Volatility is a normal part of the market cycle. It's like the weather. Just like we have sunny days and rainy days, we have bull markets and bear markets, periods of calm and periods of storm. The stock market is a living, breathing entity, constantly reacting to new information, new data, new events. And sometimes those reactions can be dramatic. But that doesn't mean you should abandon your long-term investment plan and run for the hills. Think of it this way. Would you sell your house just because it rained one day? Of course not. You understand that weather fluctuates, and you wouldn't make a major financial decision based on a single day of rain. The same principle applies to investing. Don't let short-term market fluctuations derail your long-term financial goals. Instead of panicking, take a deep breath. Remind yourself of your investment strategy, and focus on what you can control. Remember why you invested in the first place. What are your financial goals? Are you saving for retirement? A down payment on a house? Your children's education? Keep those goals front and center, and let them guide your decisions. Okay, so we've talked about what market volatility is, why it's happening, and why you shouldn't panic. Now, let's get practical. What are some concrete steps you can take to navigate this current market environment? First and foremost, take a look at your portfolio. When was the last time you really reviewed your investments? Do your current holdings still align with your risk tolerance and your long-term financial goals? If not, it might be time to make some adjustments. Diversification is key. Don't put all your eggs in one basket. Instead, spread your investments across different asset classes, sectors, and geographies. This can help mitigate risk and potentially smooth out returns over time. Make sure you have a solid cash cushion. Having some cash on hand can provide peace of mind and give you more flexibility to ride out market downturns without having to sell investments at potentially unfavorable prices. Focus on quality investments. Look for companies with strong fundamentals, solid track records, and sustainable business models. These companies are more likely to weather market storms and come out stronger on the other side. Stay informed, but don't get overwhelmed. It's important to stay up to date on market trends and economic developments, but don't let the constant barrage of news and information consume you. Find a few reputable sources you trust, and check in regularly without letting it take over your life. Remember, investing is a marathon, not a sprint. It's about making smart, informed decisions based on your individual circumstances and goals, and staying the course even when the going gets tough. Now, I know it might seem counterintuitive, but market volatility isn't always a bad thing. In fact, it can create some incredible opportunities for savvy investors. Think of it like a department store sale. When prices are down, you have a chance to buy your favorite items at a discount. The same principle applies to the stock market. When the market dips, it can be a great time to scoop up shares of high-quality companies at more attractive prices. Revisit your watch list. Have you been eyeing a particular stock for a while, but the price seemed too high? Now might be the perfect time to take another look. Consider dollar cost averaging. This strategy involves investing a fixed amount of money at regular intervals, regardless of market conditions. By buying more shares when prices are low and fewer shares when prices are high, you can potentially lower your average cost per share over time. Remember, market downturns are a natural part of the cycle. They're not a time to panic. They're a time to be patient, to be strategic, and to look for opportunities to potentially enhance your long-term returns. So, embrace the volatility. Don't fear it. Use it to your advantage. Because in the words of the legendary investor Warren Buffett, be fearful when others are greedy, and greedy when others are fearful. To sum it up, volatility is challenging, but it's also a normal part of investing. The key is to stay calm, stick to your strategy, and look for opportunities. If you found this video helpful, don't forget to like, share, and subscribe to my channel. And let me know in the comments. How are you navigating the current market conditions? I'd love to hear from you. Thanks for watching, and I'll see you in the next video. Until then, stay invested and stay informed.